Welcome traders. Today we will learn about the one candle range strategy. I have posted a video similar to this, if not 2 or 3 videos similar to this, but some of you have not understood some of the concepts that I explained in those videos. So in this video, I am going to show you a more detailed way as to why some of the things that I taught you in the one candlestick strategy have to be traded that way, and why we have to follow some of those rules. I'll also show you some of the detailed information that I did not share in the previous videos. This is a very advanced concept that I have broken down into a simple strategy. And this one candle strategy has the potential to enormously increase your win rate and profits. Therefore, by learning and mastering this strategy, you will be able to anticipate upcoming price movements and candlestick formations before they even happen on the price charts. With this powerful one candle strategy, you will not only be able to place yourself in the right side of the market, but will also allow you to trade with the large institutions. Therefore, I ask you one question. Are you ready to unlock this secret strategy? If so, well, let's get started. So as I have shown you in the past videos, every candlestick has what we call a candlestick range. Okay, I have drawn some illustrations right here, and I am going to show you why some of the things that I teach you in the one candlestick strategy work the way that they work. Okay, so in every candle, the range on a higher time frame has a corresponding price action on a lower time frame, and I've illustrated here on the bullish candle for the day and also on the bearish candle for the day. So as you know that every candle has a high. On the bullish candle, the high is the same as the high on a bearish candle, but the open and the close of the bullish candle and the bearish candle are switched. The high and the close are the same as on the bearish candle, but the open and close are switched, so you can have this clear illustration for both of them. So this candle here represents the one-day candle. Okay, let's say this is the previous day candle which has closed. Okay, so this is equal to this kind of price action here that you see right here, right? So the candle range theory, as most people like to call it, the candle range theory, it explains the price movements within this candlestick. For a bullish candlestick, we have the price open at this line right here, this black line where there's word open right here. Okay, it opens here, and then it has some price action creating some sort of a range within the Asian session, and then it has a move down to create the low. Okay, usually moves down to create the low of the bullish candle right here. This movement here is the wick. This wick here you see on the daily chart. So this is this wick. Then it moves up to create this body here. This green big body here is represented by this move between the open and the close of the candles. So after it reaches here, it normally pushes up to create the wick or the high, and then it comes down and closes at the body. So this is the representation of the price action on a lower time frame, like a 15-minute chart. Same as on a bearish side, we have the price opening up on top. It moves in a choppy way to create some sort of a range. Okay, and then it moves up to create this wick here like this. Then it moves lower to create this red body, and then moves lower to create this wick, and then closes at that line. So this is the movement of the price action of a candle represented on a lower time frame. Now, what is the candle range theory and what does it represent, and how can we use this with our one candle strategy? Guys, remember, this strategy is a very simple strategy. I've had some of you guys already send me private messages saying you're really happy you've become profitable just with this strategy, and I'm really happy for you guys who are using this strategy and you're getting profitable. Thank you guys to each and every one of you guys who have also sent me a token of appreciation. I am grateful to you. Thank you so much. All right, so to keep going, there is what we call in the market accumulation, manipulation, and distribution. This is the cycle of the market. Every single day, every single time frame, produces this kind of price action. Accumulation phase usually happens around the Asian session where the range is created, and then the Asian session range is broken by a manipulation usually during the London session, creating this M, which is the manipulation, which is this wick here. This wick is the manipulation, and then after the wick has been created, which is this manipulation move, the market distributes and moves with the highest volume that creates this body here. Okay, so you want to always be trading during the distribution phase of the market. That is why I am going to show you the illustration next, but let me show you that on the bearish side of the market. So this area here is the Asian range, which is represented by the accumulation during the Asian range. It moves up to create this wick up here on the bearish candle, which is the manipulation move. That wick rejects and then causes the market to fall lower, creating this red body here, which is a high volume time to trade, which is usually maybe the New York session. After the London manipulation, then the New York session moves the price lower or distributes the price. So you want to trade during the distribution phase. So let me show you what this means with the candle. Let me show you what this means with the single candlestick strategy and how we can apply this information right here. But just to repeat for those who have not understood, the market moves in three phases. There is accumulation, where orders are being accumulated. This normally can happen during the Asian session, during the Asian range, and then during the London session, the market can manipulate the Asian range. It manipulates it in the London session and then starts to distribute it with a high volume the opposite way during New York session, which creates the body of the candle. The distribution phase is what creates the body of the candle. The manipulation move is what creates the wick of the candle, both here and on the upper side. Okay, so it's also the same with the bearish market or bearish candle. The Asian session creates an Asian range on after the open. It creates Asian range, which is then manipulated during the London session and then distributed during the New York session. So you always want to trade during the distribution phase, because that is what creates this volume of the candle here, the body, both on the bearish and bullish sides of the market. So let me show you that on the one candlestick strategy and how that works. So we have the same illustrations right here. We have this single candlestick here on the bullish side of the market. So this bullish candle is the same as this one here. Just copied this and I've put it here and I've added in some illustrations. So when this candle closes up here, this blue line here or blue graph line here would represent the next day's candle and why we trade within the purple zone. You see, I have marked out the purple zone right here, which on the bullish candle, it is between the close of that bullish candle and its low. Between the close of that candle and the low, we only trade within this purple zone. And for the bullish, for the bearish market, we only close between the high of that candle. Okay, only between the high of that candle and the close of that candle. So you can see that this purple zone here is within the distribution of the market. It has to be within the distribution phase of the market, right? So the reason why I told you on the one candlestick formation you trade within the purple zone is because the purple zone is where the distribution happens. So why does the market tend to pull back into the purple zone? Why does this happen? It happens because during the distribution phase of the market, there is higher highs, higher lows, higher highs, higher lows being created. And the market is not taking out the liquidity below these areas here. Okay, let me show you. It's not taking out liquidity in these areas here. There's a lot of liquidity sitting here. So normally what happens is that the banks or large institutions like to pull the market back down. They like to pull it back down to these areas here. That's why I put these dotted lines here. Those are areas where liquidity is at the higher lows of the previous day distribution zone, which is within this purple zone. So those orders which are here, the stop losses which are at those higher lows, okay, have to be taken out or they have to be filled so that the market gets volume to start to price higher. So that is why on a bullish candle, you wait for this wick, this movement of the blue line down here. this move down here, this move here is the wick of the next day. Okay, this is the wick that is being produced here. This is the manipulation wick right here. So this manipulation wick is meant to fill the orders around these red circles here, so that these orders, the stop where the stop losses are taken out to give the market a movement to the upside, which would be the distribution. I hope you guys have understood that. On the bearish candle, this is why I asked you to trade within the purple zone. It's because within the purple zone, that is where the market tends to trend. Okay, it tends to trend to the downside on a bearish market around the distribution zones. So those distribution zones usually leave their lower highs. At those lower highs, there is liquidity. People put their stop losses on top of lower highs as they are selling the market during the distribution phase of a bearish day candle. So normally in the next day, this liquidity here has to be filled. Okay, it has to be filled. So this area here is the wick. It's the wick of the next day's bearish candle. This area. So that wick there goes up to manipulate and take off all this liquidity up here before the market continues to fall down. That's why I asked you guys last time to try and trade within the purple zone. That is the reason why you trade within the purple zone. If the market pulls up, for example, here, if the market comes down the way it was coming down like this, it comes down and goes beyond, takes out all liquidity here and goes beyond and breaks below here like this. It means that the market is not hunting this liquidity here. It means the market is reversing. That is what this means. That is why I told you when the market breaks the previous day's low or previous day's high, you don't trade. If it breaks the high like this, okay, and continues going, retesting and going up, you don't take that trade anymore. You just leave the market alone. Same as the bearish side of the market. If the market, instead of going up like this, it just continues and breaks down below and retests like this and does this, you don't take a trade on that day. Wait for the next day. Or in this manipulation move, if the market moves beyond the purple zone and does this, you know that the market could be reversing to go up. So you always have to keep your eye on that when you're trading, right? That is why on the last video I asked you to use a Fibonacci. Okay, so for Fibonacci, you would draw your Fibonacci, for example, on a bearish market from this high, you draw your to the low like here. Okay, you can see that without even trying, you can see that this pulls into golden zone. I didn't plan this ahead, but it pulls into golden zone. Then you can look for bearish engulfing or bearish candlestick formations around here for you to short the market and sell the market from around that area like that. You can use this as your stop loss area and target a 1 to 1, 1 to 2 as you go like this. So that is the entry model for the bearish candle. And also you can use Fibonacci from the previous day's bullish low, the previous day's bullish high. This one also comes exactly to golden zone. I didn't plan this ahead, but it's just an illustration. You can see you enter your trade around there and you can put your stop loss down here. Okay, and then you target a 1 to 2 up there like that. Okay, I hope you guys have understood this entry. Now let me show you guys on a live chart with some small twist what that means. I've already drawn out some levels, but let's go down to the 15 minutes chart. On the daily, we've drawn out the candle high and close already. So let's go down to the 15 minutes. So you can see on the 15 minutes time frame, we have this dotted line here. That is the daily close. Okay, the candle for yesterday closed around here. So this is the red dotted line, is the daily close for yesterday's candle or last week Friday's candle, because I'm recording this on a Monday. So this is the close of Friday's candle, this red dotted line, and the dotted line above it's a high, okay, and the dotted line below is its low. So you can see that the market created accumulation, where I've marked with the A. This is the accumulation phase, the wick. Okay, this is the first accumulation being created here. This is today's wick being created by the manipulation here. Okay, this is the accumulation Asia range, the manipulation creating a wick which is within the purple zone. You can see it's within this purple zone. Now this purple zone here, you may ask that why didn't you draw the purple zone from this candle's close, which is this red dotted line? The red dotted line is its close, but you can see that there is a gap here in the market. Okay, the market gapped here. So when the market gaps here, what do? When the market gaps, you know that you consider the close, this one here. But the close, if you pull this up here, you'll have not considered the close. So this gap here, you cover it. Make sure the purple zone covers the gap. So you can see that the market manipulates into the purple zone, and it gives you, this is a manipulation area here, and now it gives you the distribution where you're supposed to enter your trades from. This is the distribution where you see this bearish engulfing. This is where you could enter a trade like this. You can put a stop loss above here, and then you can look for a 1 to 2, 1 to 3, which I am seeing might happen at the end of the day. Okay, so this is a current trade that is running live. You can see that this would be a sniper entry because you followed the AMD model: accumulation during Asian range, manipulation during the London, and then the distribution, which is now happening during the New York session. This is how you can trade the one candlestick strategy using the candle range theory. Let me go back to the daily chart so that we can consolidate this knowledge and let you guys understand it a bit more. Let me just explain it to you a bit more. You see this, this price action here shows the accumulation, manipulation, which creates the wick, and then the distribution. Remember to always trade during the distribution phase, both on the bullish market and also on the bearish market, because that is when the trend or the volume of the day is distributed, and that you will have a higher chance of succeeding when you trade the one candlestick strategy. I hope this explains to you guys what you needed to know about the candlestick strategy that I've been showing you. If you don't understand this, please comment down below with your questions. And also, if you've not understood something, I'm sure I might have even spoken about it in the video. So what you do, you just go back to the video and watch the video again. I believe you will get the solution there. You can go and watch these 4 videos that are going to be coming up next. They'll explain to you guys the one candlestick strategy in detail. Thank you guys for watching, and if you've liked this video, please do leave a like on the video. Support the channel by subscribing to the channel. You can also join my channel's membership. It is very cheap, just about $2 every single month. Thank you guys. And for those of you who want to send me a token of appreciation, you can reach me on my WhatsApp, and then we can arrange that. Thank you guys for watching. Until next time, peace and out.